Today, we're going to look at the potentially significant difference between taking out agreed or indemnity valued income protection. We're going to go through a couple of case studies to demonstrate how these can significantly affect your client.
Let's look at a comparison between agreed value and an indemnity value when it comes to income protection. We'll look at a scenario where we have a tax auditor earning $100,000 a year. The auditor has a midlife crisis and decides to become a circus acrobat. The green line represents a significant drop in that pay from $100,000 down to $40,000 a year. Now, in the event this auditor had initially taken out an agreed value contract, you can see the red dotted line represents that $75,000 worth of cover has been locked in and will stay fixed for the duration of the contract as long as premiums are continuing to be paid. Let's contrast this with the indemnity style contract represented by the blue line. You can see here that the blue line will drop from the point of the career change until 12 months after they've been in the new career to then settle at 75% of the new income amount, being $30,000 worth of cover. So in this scenario, let's assume that the auditor who's now an acrobat has broken their arm. A broken arm would more than likely prevent a circus acrobat from being able to perform their duties. However, an accountant or an auditor would still be able to perform their duties, but given that income protection is always based on your occupation at the time of claim, that would satisfy the claim criteria in this instance. So, under an agreed value contract, our acrobat would be getting paid 75% of their initially agreed upon amount, which is $75,000 a year. Under an indemnity contract, they'd be getting 75% of the previous 12 months' earnings. So in this instance, they'd be getting paid $30,000 a year. You can see here that there is a significant difference in this example given a drop in salary. If we considered the alternative or the reverse, where someone has increased their salary, an indemnity contract would not rise above the agreed or the initially agreed amount. So indemnity, point of distinction, is always the lesser of the initial agreed amount or the 12 months immediately prior to claim. So that's an important distinction. Where we consider a career break. So this time we've got our same tax auditor who has worked for a couple of years. In year 3 decides to take 12 months of unpaid leave, and in year 4 returns to full-time employment and continues working throughout. So under an agreed value contract, you can see the red dotted line, as we've seen previously, is locked in and fixed at $75,000 per annum. The blue line, representing indemnity, has a spike going downwards during that 3rd year and then recovering during the 4th year and settling once again at the $75,000 mark. Let's take a scenario where the auditor, 6 months after returning to work, after their break, suffers an accident, and that accident prevents them from working. Under an agreed value contract, they're going to be receiving 75% of the agreed amount, so $75,000. Under an indemnity contract, they're going to receive 75% of the previous 12 months' work. Given that this is only 6 months after returning from their career break, they've only earned $50,000 of their $100,000 salary. Therefore, they'll only be covered for 75% of $50,000, shown there as $37,500. So once again, indemnity and agreed have a very significant difference in terms of the amount being paid in this type of a scenario. I hope this clarifies things around agreed and indemnity.
This has been Eddie from Curto Consult. Thanks for watching.